Hello friends, welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to investment property, that is Indian Accounting Standard 40. This standard does not say about investment in shares. This standard generally deals with the investment in property. Property means land and building. Only land and building it's an asset based standard. It's a small standard. So let's start our topic. Firstly, we will discuss about the agenda, what we will going to discuss in this standard. Firstly, we will discuss the objective of this standard, what was the purpose of this standard. Then we will discuss about the scope, applicability and non-applicability of this standard, to whom this standard is applicable and to whom this standard is not applicable. Then definition of investment property. Then the in definition of investment property, what are not included? Investment property does not include what? Then we will discuss about the definition of owner occupied property. Then some examples, case laws, whether they are investment property or not. Then if the property is held for more than one purpose, that is there is more than, if the property is used for more than one purpose, that is mixed use, then how they will classify. Then we will discuss about the definition of ancillary service along with the service which are given by the owner to the tenant. Then recognition principles of initial recognition and subsequent recognition. Then measurement principles, both initial and subsequent. Then discussion on deferred payment. Then application on barter system. Barter system means exchange of one asset with another asset, or both non-monetary or non-monetary asset. If one asset is exchanged with another asset, or if one exchange is exchange with monetary or non-monetary asset, then how the company will deal is says under this standard, is guided under this standard. Then defer treatment at the time of de-recognition, how the company will de-recognize this investment property, what was the treatment at the time of impairment. Then difference between Ind AS 40 and IAS 40, the disclosures. All these we are going to discuss. The objective of these standards is to prescribe the accounting treatment for investment property. The accounting treatment of investment property is prescribed by this standard and the related disclosure requirement. Generally, accounting treatment of investment property and their disclosure requirement are discussed. The objective of this standard is to prescribe or to guide the accounting treatment for investment property and how to disclose these in the financial statement. Scope part, this standard is applicable in applies in the recognition, measurement and disclosures of investment property. The scope includes the recognition, measurement and disclosures of investment property. Investment property means only land and building are covered under this standard, and which is the land and building which is used for renting purpose and for capital appreciation. Then that land and building is covered under this standard. If the land and building is used for any other purpose, not for earning rent, not for capital appreciation, then there is a separate standard for that. This standard does not apply to biological asset which is related to the agricultural activity. There is a separate standard for that biological asset which is related to agricultural activity, which we had discussed in Ind AS 41. That this standard Ind AS 40 does not apply to biological asset and mineral rights and mineral reserves such as oil, natural gas and similar non-regenerative resources. What do you mean by the definition of investment property? What investment property defines? Investment property is the property that is land or building or part of building or a part of land or both. Means investment property is that property which covers land or building, part of land or building or both, which is held by the owner, which is acquired by the owner by himself or by the terms of lease, by the lease as a ROU asset. Lease means if the entity has taken a building on lease or land on lease for sublease purpose, sublease purpose, or then that asset are also covered under investment property if the purpose of that asset is to earn rentals or for capital appreciation. The intention of the management is to earn rentals or capital appreciation, then that land and building is treated as an investment property. But if the purpose is for any other, then rental income or capital appreciation, then that asset is not covered under this standard. Investment property does not include. It does not include what are out of the purview of this definition. Investment property: property which is held for use in the production or supply of goods or services for administrative purpose. The asset which is used, the land or building which is used as a factory building or for office building, the office purpose, then that land and building are not used, not treated as an investment property. There is a separate standard for that, that is Ind AS 16. Sale in the ordinary course of business: if the land or building is used for sale in the ordinary course of business, like renting of flat or land is sold, if the dealer will purchase a land and for the purpose of sale in the ordinary course of business, then that is treated as an inventory, and that is out of the purview of the definition of investment property, and there is a separate standard for that, that is Ind AS 2, that is inventory. Employee occupied property: if any property is given by the employer to employee for their accommodation purpose, then that property, that employee occupied property, is treated under as a PPE and not an investment property, because the purpose of the use of that asset is for office purpose. The employee of the office is using that asset, is used for office employees purpose. So this is treated as a PPE under Ind AS 16. And property that is leased out to another entity under finance lease, because if the company has given a property under finance lease, then they has to derecognize that property from their, or eliminate that asset from their balance sheet. So there is no question to treat that asset as an investment. Then what do you mean by owner occupied property? Owner occupied property is the property held by the owner or by the lessee under a lease as a right of use asset for use in the production or supply of goods or services or for administrative purpose. It is also treated as a PPE, property, plant and equipment, because the purpose of these assets is to use that asset for the office use. Whether they owned by themselves, by the entity, or whether taken on lease as a ROU. Then in both the cases, if the purpose, intention of the management to use that asset for production, for the factory purpose or for office purpose, then that asset is treated as under PPE, not as a property investment. What is cost? Cost is the amount of cash or cash equivalent paid or the fair value of other consideration given to acquire an asset at the time of its acquisition or construction, or where applicable, the amount attributed to that asset when initially recognized in accordance with the specific requirement of other staff. Cost means cost is the amount of cash or cash equivalent paid, cash or cash equivalent paid, or the fair value of other consideration given when there is an exchange of asset or there is a barter system, then the fair value is taken, considered as an cost. Cost is generally a cash or cash equivalent or fair value of other consideration. Other consideration means in exchange of asset given to acquire an asset at the time of its acquisition or construction. What is carrying amount? Carrying amount is the amount at which an asset is recognized in the balance sheet. The date when the asset, the value, the outstanding value at the reporting date, or the carrying amount at the reporting date, which is recognized in the balance sheet, is the carrying amount. There are some examples. Case laws, whether the property is an investment property or not, that is serial number, particulars, whether investment property or not, which Ind AS is applicable. Case 1, Land held for long-term capital appreciation. If the land is held for long-term capital appreciation rather than for short-term sale in the ordinary course of business. As we know, capital appreciation and rental purpose covers the definition of investment property. So if the land is held for long-term capital appreciation, then it is an investment property and covered under Ind AS 40. Land held for a currently undetermined future use. If the entity purchases a land at a very nominal value, at that time, at the time of purchase, company does not know the purpose of the use of that land. They purchase because of the value is very nominal. At the time of purchase, they does not determine the future use of that land. So in that case, it will be treated as an investment property until and unless the company decides the use of that land. So if the entity has not determined that it will use the land as owner occupied property or for short term sale in the ordinary course of business, the land is regarded as a held for capital appreciation. Then if the purpose is not determined, then it will be treated as an investment property unless and until company decides whether they will use what was the purpose of that land, for what purpose they will use that land. So it will be treated as an investment property and covered under Ind AS 40. A building owned by entity or a ROU asset relating to a building held by the entity and leased out under one or more operating lease. Means if the building is owned by a company, a entity, if the building is owned by the entity or they had taken that building on lease and sublease that asset. If they own the asset, they lease the asset for renting purpose, or if they had taken on lease basis and they sublease the asset for one or more operating leases, then that asset is also treated as an investment property and covered under Ind AS 40. Property held for future development and subsequently used as a owner occupied. Property which is developed and used for the purpose that they will use as a owner occupied property. So that is not an investment property, and there is a separate standard for that is Ind AS 16. They will use that property as a PPE. Property occupied by the employee. Even the property occupied by the employee are not covered under the definition of investment property. Even the employee are paying at market rate, the rent paid by the employee at market rate or below market rate. So this is not an investment property and this is covered under Ind AS 16. A building, even a building that is vacant but it is held to be leased out under one or more operating lease. A building, though they are vacant for 2 years, 3 years, but the purpose of the building is to leased out for renting purpose, then that building is an investment property under Ind AS 40. Property occupied by employee below market rate, if the rent received is and the employee are not paying any rent, then that is not an investment property covered under Ind AS 16. Owner occupied property held for sale. If the property held for sale, there is a separate standard for that. This is not an investment property and the separate standard will be covered under Ind AS 105. Property that is being constructed or developed for future as an investment property. Property developed or constructed with an intention to use as an investment property, then that property is covered under investment property and covered under Ind AS 40. If the property intended for sale in the ordinary course of business or in the process of construction or development for such sale. Property intended for sale, if the purpose of the entity is to sell that asset in the ordinary course of business or in the process of construction or development, then that is not an investment property, that is covered under Ind AS 2, that is the inventory. property leased out means if the purpose of this entity is to purchase a land and build a building on that, or build a flat on that, and that flat is to be for the purpose of sale, that then that is an inventory, and that is not an investment property and covered under Ind AS 2. Property leased out to another entity under finance lease. If the property is leased out to another entity under finance lease is not covered under investment property. If any property is leased out under finance lease which is not covered under investment property, and there is a separate standard for that, that is Ind AS 116. Because in case of finance lease, property is eliminated from the balance sheet, so there is no question of treating that. If the property is not there, how could we treat that property as an investment property? Property partly owner occupied and partly leased out under operating. If there is a one building of 5 floors and 3 floors is used for office purpose, and say upper 2 floors are used for residential given by the entity on rent to the tenant, then it will be partly owner occupied property and partly leased out property. Then partly for 3 floors which is used for office purpose is treated as a PPE and governed by Ind AS 16. And for partly 2 floors, upper 2 floors which is given by the entity for on renting purpose is treated as an investment property governed by Ind AS 40. Property held for more than one purpose. If the property is held for more than one purpose or for mixed use, the purpose of the property is to use, or for more than one purpose, there is a dual use of that property or mixed use of that property, then how the company will treat in the financial statement. When the property is held partly for capital appreciation or rentals, and partly for production or supply of goods or services, or for administrative purpose, means when the property is used partly for renting purpose or for capital appreciation and partly for office use, then if the company is able to split that asset, the value of the asset, if able to determine the value of the asset, they will able to split the value of the asset, then they will account that separately for PPE and separately as an investment property. But if they are not able to split the value of that property, then they have to check the significant portion of that property. If the investment property is insignificant, then it will be treated as a PPE. And if the PP property plant portion, property plant equipment portion which is used for office purpose is insignificant, then it is used as treated as an investment property. So significant portion to whom it will be considered in case of if the company is not able to split the value of the asset. If they could not be sold separately, if they will not able to sell that property separately, the property is accounted for as an investment property. They will treat that asset as an investment property only if an insignificant portion is held for use in the production or supply of goods or if the insignificant portion is PPE, then that property is accounted as an investment property. If the insignificant portion is investment property, then that property is accounted as an PPE. In case if they are not able to split. This is to be explained by example. Suppose Sun Limited own a building having 15 floors, of which it uses first 5 floors for its office use and remaining 10 floors as a leased out. Remaining 10 floors leased out to a tenant under operating lease. According to the law, company could sell legal title to the 10 floor. Company could sell legal title to the 10th floor while retaining legal title to the other first 5 floors. Means the company can sell independently each and every floor. Then they are able to split that property, and thus for first 5 floors which is used for office purpose, they will recognize account for as a PP, and the remaining 10 floor which is used which are leased out to the tenant will be accounted as an investment property. And there is another example. Moon Limited uses 35% of office floor space of the building as its head office, and it leased out the remaining 65 to the tenant, but it is unable to sell the tenant space. They are not able to sell the tenant. They don't have the power to sell the tenant space or to enter into finance lease related solely to it. Means they are won't be able to split that asset. In that case, we will check the significant portion. In the above case, company is not able to split the property, then the company need to check whether the owner occupied property, means that is the property which is used for office purpose, is significant or insignificant. In the above case, the owner occupied property is 30%, which is insignificant according to my perception. It is my perception, but in CA Institute, it is said that the 35% is a significant portion, and it is treated as a PPE because the tenant space is not able to sell solely, because the company will, or the Moon Limited, not independently sell the property. For that purpose, it will be treated as a PPE, property, plant and equipment, and not an investment property. Though the 65% of the property is in investment property, but in this case, it will be treated as a PPE, but according to my perception, it will be treated as an investment. What do you mean by ancillary services? Any services. In some cases, an entity provides ancillary services to the occupant of the property it holds. Means any services in addition to the asset which is given on lease. So any extra services, so that services is to be considered or called as an ancillary services. Suppose security guard services, maintenance services, which is given by the owner of the building to the lessee when they occupy the building. Any extra services given by the owner of the property to the tenant, then that services is called as an ancillary services. And if the services is significant, and then that property is not considered as an investment property. If the ancillary services is significant, then that property is not considered as an investment property, because in investment property the services is not provided significantly. Like they are providing room cleaning services, they are providing laundry services, they are providing fooding services, they are providing security guard services. All these services, in addition to the building given on rent, then that services, that asset is not treated as a investment property, because the services which is provided along with the renting purposes, then that portion of significant services is for commercial use and not for, so it is not treated as, it is treated as a PP and not an investment. In some cases, an entity provides ancillary services to the occupants of the property it holds. Means they provide ancillary services to the person who holds the property. An entity treats such a property as an investment property when the services are insignificant. If the services are insignificant, they will treat the property as an investment property. As a whole arrangement, this is to be explained by example, is when the owner of the building provides security services maintenance services to the lessee who occupy the building. In another case, the service provided are significant. Significant services are provided to the tenant who holds the property. For example, if the entity own and manage a hotel service provided to the guest are significant, like they are providing fooding services, lodging services, cleaning services, laundry services. All the services are provided by the hotel to its guest, then that services are significant, and to the arrangement as a whole. So that kind of property is treated as a owner managed hotel, is treated as a owner occupied property rather than investment. Concept in case of consolidation. Suppose A Limited is a holding company given building on lease to B Limited, its subsidiary. A Limited is a holding company given its building on lease to B Limited, who is the subsidiary of A Limited. B Limited uses that building for its office purpose. How the company will treat this transaction in their standalone financial statement, both the company A and B, and how they will treat this transaction in the consolidation financial statement. So the solution will be A Limited, who has given its building on lease for the purpose of earning rent. They will treat this transaction as a investment property and shown in its financial standalone financial statement as an investment property. B Limited, who use this asset, who acquired the asset on on lessee as a lessee on lease terms and treat this asset as an ROU asset, which is under PPE, because the purpose of the B Limited is to use that asset for office purpose. So they will recognize this asset as an ROU asset under PPE, not under investment property. And in consolidated financial statement, they will recognize this asset as a PPE. Because why PPE? Because the entire group A and B are treated as the same group, and they will use this asset as a office purpose. So it will be treated as a PP and not an investment property, because the building is used by entire group as a for the business. Now, recognition of investment property. How the company will recognize the investment property. An owner in an owned investment property shall be recognized as an asset when and only when the owned means the owned investment property which is purchased by the owner, its own property shall be recognized as an asset only and only when there is a future economic benefit which flows to the entity and the cost of investment property can be measured reliably. Then only they will recognize this asset as an investment property. If the future economic benefit will flow to the entity and cost can be measured reliably. And in case of that is in case of owned investment property, and if the property is also leased, taken on lease as a lessee, then they will treat ROU asset and shall be recognized in accordance with Ind AS 116. Initial cost recognition of investment property. How the company will recognize cost initially? The cost which is incurred at the time of purchasing the property, and it should be capitalized. The cost which is incurred at the time of purchasing the property, that cost is considered as an initial cost and it should be capitalized. And subsequent cost of the investment property. Subsequent cost recognition means day-to-day servicing cost, like repairing cost, wall painting. All these type of cost are treated as a day-to-day repairing and maintenance cost. Cost of day-to-day servicing are primarily the cost of labor, consumables, and may include the cost of minor parts. The minor parts and repairing and maintenance, it will be considered as a repairing and maintenance cost. And day-to-day servicing costs are not included in the carrying amount of the means these costs are not included. Repairing and maintenance cost, which is day-to-day servicing cost and which is very minor, then that cost is not capitalized with the cost of investment property. If the cost is measured and that cost, the cost is measured and that cost is incurred for that, for the future economic benefit, from that incurring cost it derives a future economic benefit flow to the entity, then that cost is to be considered as a, and that cost is to be capitalized with the uh, cost of asset. Otherwise it should be charged to P&L. Any other cost which is minor cost, day-to-day servicing cost, is to be charged to P&L as they incurred. But if the cost is measured and for that cost there is some future economic benefit derives to the entity, like replacing a wall and with new walls, then that is a major cost, and which flow and that replacement cost flows future economic benefit to the entity, then that cost is to be capitalized with the cost of asset. Any dismantling cost, if any asset is to be dismantled in future but the cost is to be recognized today, then that cost is also to be treated as a subsequent. Replacement cost, if the recognition criteria is met, means recognition criteria means future economic benefit is probable and cost can be measured reliably, then recognize in the carrying amount of the cost of the replacing part. Then if the criteria means the if the cost is measured and cost can be measured reliably and the future economic benefit flows to the entity, then it will be the replacing part cost is to be added with the cost of property, and the cost of original part or the carrying amount of the original part which is replaced with the new part is de-recognized. Means new cost of new asset is to be recognized and cost of old asset or replaced asset is to be de-recognized with the investment property, with the carrying amount of the investment. Illustration. X Limited own a building which is used to on rental. The building has a carrying amount of rupees 50 lakh. X Limited recently replaced interior walls of the building and the cost of new interior walls is 5 lakhs. The original wall having a carrying amount of rupees 1 lakh. How X Limited should account for the above? Replacement cost will be, means the carrying amount of the building is 50 lakhs. The cost of new interior wall is 5 lakhs and the cost of the original wall for which the new interior wall is replaced is 1 lakh. So 50 lakhs plus 5 lakhs, that is the cost of new wall minus the cost of old wall. Then it will be 54 lakhs. The replacement cost will be 54 lakhs. Initial measurement principles. What was the initial measurement principles? An investment property shall be measured initially at cost, including transaction cost. Measurement means the value at which the property is to be recognized. Means they will measured initially at cost including transaction cost. Cost means the purchase price including import duties, non-refundable purchase tax after deducting trade discounts and rebates. All import duties to be included, non-refundable taxes is to be included after deducting trade discount and rebates. If the taxes are refundable, that also is to be reduced. Non-refundable taxes are those tax for which they will not incur any take any input credit, and refundable taxes are those tax for which they will take the input credit. That's why it will be reduced. And directly attributable cost means transaction cost, means any cost which is incurred to bring the asset to its present location and condition necessary for its intended use by the management. Any asset which is you incurred to bring that asset to its present location on condition necessary for its intended use by the management, necessary for the purpose of that use Without that cost, the entity will not able to use that asset. That cost is a direct attributable cost, like any license, any stamp duty, municipal taxes, property transfer taxes, or any stamp duties, legal services, professional fees, other transaction costs that are directly attributable cost and is to be added with the cost of asset, initially cost. Initial estimates of dismantling cost, removing cost or restoring cost which incur after lease period is over. Means after lease period, that cost, the cost which is incurred after 5 years, means after the lease period, is to be recognized today. The present value of that cost is to be recognized today. The estimate of that cost is to be recognized today, like dismantling cost. If the company will dismantle that asset after 5 years, then what was the cost incurred after 5 years? The present value of that cost is to be added with the cost of asset. Amount not included in the cost of investment property, like operating losses incurred before the investment property achieve the planned level of occupancies. Operating losses means if the company has developed a building or construct a building and for renting purpose with an intention to use that building for renting purpose, but the company for 2 years the building is lying vacant, and the company incur maintenance cost, security guard expenses on that building, so it's operating losses. So but the intention of the management is to use that building for renting purpose only, though they are vacant for 2 years, but still that losses is not added with the cost of investment property. It is to be charged to P&L, incurred before investment property achieve the planned level of occupancy. That losses is to be charged to P&L and not added with the cost of asset. Startup cost. Any startup cost, unless they are necessary to bring that cost which is necessary to bring the property to its present condition and location for the management use, for the intended management use, that cost is to be added. But the cost which is not used, which is not necessary to bring the asset to its necessary property to its present condition and location in the manner they intended by the management to use, then that cost is not added with the cost of property, cost of investment property. Abnormal loss, abnormal amount of wasted materials, labors or other resources incurred in constructing and or developing the property. Any abnormal loss like waste materials which is used during the construction period is wasted material, wasted labor or other resources during the construction developing period, then that abnormal loss is to be charged to P&L and not added with the cost of investment. This is to be explained by example. Suppose X Limited purchase a building for rupees 30 lakhs on 1st May 2022 with an intention to earn rentals. It is funded by loan. It is funded by loan interest rate will be 12%. Property transfer taxes and direct legal cost will be rupees 1 lakh and 20,000 respectively for acquiring building. X Limited redeveloped the building into shop for rent under operating lease to the independent third party. Cost incurred on that planning permission is rupees 2 lakhs and construction rupees 7 lakhs, and out of which 40,000 will be the refundable taxes. Advertisement expenses to attract tenant is rupees 3 lakhs. Opening ceremony function for starting is rupees 2 lakhs. 1 lakh incurred towards day-to-day repairing expenses. Calculate the cost of building as per Ind AS 40. Firstly, the building is used with an intention to earn rentals. So it's an investment property. The Purchase price will be 30 lakhs. Then property transfer tax added 1 lakh. Direct legal cost 20,000 added. Planning permission 2 lakhs added. Construction cost 7 lakhs. It will be also added. 40,000 will be refundable tax. It will be reduced from that. Advertisement expenses not added. It will be charged to P&L. Or opening ceremony function expenses charged to P&L. 1 lakh day-to-day repairing expenses charged to P&L. So the calculation 30 lakhs plus 1 lakh plus 20,000 plus 2 lakhs plus 7 lakhs minus 40,000, it will be, the total cost will be 39 lakhs 80,000. Now deferred payment. What do you mean by the deferred payment and how the treatment is to be done? What if the company will pay after 2 years if they purchase today? If the company will purchase any asset today and pay after 2 years, then the cost, what was the cost of that asset? If they will pay today, the value of, suppose this is to be explained by example, if they pay today, the value of the asset will be 14 lakhs. But if they pay after 2 years, the value of the asset will be 16 lakhs. So these 2 lakhs is an interest component. That it means they are deferring the payment of that property, that asset. If the payment for the investment property is deferred, its cost is the cash price equivalent. The difference between this amount means cash price equivalent and the total payment which the company has made is recognized as an interest. Means suppose the company has paying 16 lakhs and the actual cost of that asset, if we pay today, is 14 lakhs, then the differential amount will be considered as an interest component, as an interest expense over a period of credits. In case of a deferred payment beyond credit period, which means difference between cash price equivalent and total payment is recognized as an interest in the PL over the period of credit, unless such interest is capitalized as per Ind AS 23 as a borrowing cost. Tells that such cost relates to qualifying asset, then only interest expense is to be capitalized, otherwise it will be charged to P&L. If the interest cost is related to the qualifying asset, then that cost is to be capitalized with the cost of asset, otherwise it will be charged to P&L over a credit period. This is to be explained via example. Suppose company purchase a land on credit payment term at 15 lakhs. The date of purchase is 1st April 2022. Payment terms is 3 installment in 3 years and interest rate will be 6%. Calculate the cash price equivalent. What was the price today which the company is going to pay after 5 years, after 3 years is 15 lakh. So 1st April 2022, the payment company has made 5 lakhs, means 3 installments they are going to pay. The present value factor at the rate 6% is 1, because there is no interest component on that. So present value will be 5 lakhs. On 1st April 2023, after 1 year, they are going to pay 5 lakh and the present value component at the 6% rate, that is 1 divided by 1 plus 6%, which give rise to 0.943, which is and we will get the present value 5 lakhs into 0.943, then which give rise to 4,71,698. That is the present value. And after 3 years, that is 1st April 2024, the company is required to pay 5 lakhs. The present value of that is, present value factor we have to find out first, 0.943 divided by 1 plus 6%, that is give rise to 0.890, which we will multiply with 5 lakhs to get the present value, that is 4,44,998. And in total the company is paying 15 lakhs, but the present value of that 15 lakhs will be 14 lakhs 16,696. The difference will be the interest component. Difference between 14 lakhs and 15 lakhs is the interest component. That is, the interest will be, this will be the interest, the difference between that. Means calculation of interest component, the period, opening balance, interest rate, payment at the beginning, principal, closing balance. On 1st April 2022, the opening balance of the asset, the actual cost of the asset, cash equivalent, that is 14,16,696, which is the present value of the asset, on which interest rate will be 6%, because at that time there is no interest at the year 1, and the company has make a payment of 5 lakhs and the principal amount is also 5 lakhs, and the differential amount will be 9 lakh 16,696, and in next year the opening balance will be 9 lakh 16,696, on which the interest component will be at the rate 6%, which give rise to 55,001 on 5 lakhs minus the interest component, which is the principal amount, and the closing balance will be 9 lakh 16,696 plus interest part minus the payment part, that is the remaining balance 4 lakh 71,698, and that will the closing balance becomes the opening balance in 24, and the interest is to be calculated at the rate 6% on that, which give rise to 28,302, and the company has make a payment of 5 lakhs, which is interest and principal and interest component. The difference between 5 lakhs and 28,000 give rise to a principal, that is 4 lakh 71,698, and the closing balance will be opening plus interest minus the payment made by the company, which becomes nil. So in the year 3, the company has fully paid the amount. Now, exchange of assets or application of barter system. How the company will treat the asset in case of barter system. Suppose if the land is acquired in exchange for a building, or for exchange of a combination of monetary and non-monetary asset. Barter system means if the one asset is acquired in exchange of another asset, or one asset is acquired in exchange of asset, both monetary and non-monetary asset, like both cash and other assets. This is to be explained by example. Suppose if an entity purchase land in exchange of building and also cash, in exchange of building and cash, the company has purchased a land. It is a combination of monetary and non-monetary asset. And if there is a commercial substance, then the asset is to be recognized at a fair value or depending upon the situation. If there is a commercial substance, then asset is to be recognized at the fair value. Commercial substance means if one asset is exchanged with another asset of different nature and use. If the nature of that asset is of different use or purpose, the nature and classification of the asset is both the are different, then there is a commercial substance. But if the class of the asset or nature and class of the asset is of same, means the land is exchanged of the same nature with the same nature of land, then there is no commercial substance. In that case, the fair value is not taken into consideration and there is no commercial substance, then the cost is to be taken for that transaction. Fair value is not considered for that, is not recognized. Fair value has to be taken depending upon the situation. If both the asset given, fair value of asset given and asset acquired are identifiable, then they will take into consideration the fair value of asset given. The asset which is they are going to give for acquiring another asset, that asset fair value they will consider for recognition purpose. And if both the fair value of asset given and asset acquired is not clearly identifiable, then they will take into consideration the WDV of the asset given. The written down value of the asset given is to be taken into consideration for recognition purpose. And if any of the fair value of the asset given and asset acquired is considered, if there any of the if asset given value is there or asset acquired is value there, then the asset whose amount is there, that is to be taken into consideration. Means if the fair value of the asset given or acquired, then the value is to be taken into consideration whichever fair value is identifiable. Means if asset given value is there, fair value is there, then they will take that, and asset acquired value is there, they will take that for the recognition. In barter system, investment property is recognized as cost only and only when there is no commercial substance, transaction, and the fair value of the asset given and asset acquired is not identifiable. If they will not able to identify the fair value of asset given and asset acquired, and there is no commercial substance, then the company will recognize the investment property at cost only. This is to be explained by example. Suppose land is purchased in exchange of land of similar nature, similar class of asset, and similar use of asset, nature and class of assets, and there is no commercial substance in this transaction, then the fair value of the asset is also not identifiable. Then cost, that is WDV of the asset given, is to be taken into consideration for recognition. Now, treatment of asset at the reporting date, that is after initial recognition, how the company will treat the asset at the reporting date, that is after initial recognition. What they will do, they will charge depreciation on that. They will if there is an impairment loss, they will recognize that. They generally use only the cost model. For investment property, the company will use or measure the cost only by using cost model, because cost model as per Ind AS 40, both in case of own property and also a leased out property. Means if the company having his own property, in that case also they will use cost model, and if the company has taken a property on lease, in that case also they will use the cost model, because they will after initial recognition in investment property, the company will not use fair value method. Why fair value method? Because it unnecessarily inflated the price of the property, and inflated the price of the property. But that's why the company uses using cost model rather than fair value model, because it is eliminated from Ind AS 40. Fair value method is model is eliminated from Ind AS 40, though it will be existed in IFRS 40, but in Ind AS 40 fair value method is not permitted. Because why they are not permitted? Because they are unnecessarily inflating the price of the asset. But it is the fair value is not applicable for accounting purpose in Ind AS 40, but the company is required to disclose the fair value in the notes of the financial statement. In the notes of the company's financial statement, the fair value of that asset is required to be disclosed, but it is not used for accounting purpose. How the company will calculate after initial recognition? By using cost model, that is cost of asset less accumulated depreciation less impairment loss, then the company will determine the carrying amount of the. In some cases, investment properties are not required to adopt cost model. Means in some cases they are not adopting the investment properties, are not using the cost model. What was the case is, if the property held for sale and discontinued operation, it meets the criteria. Means if the investment property are held for sale or for discontinued operation, then they will treat under Ind AS 105 and not under investment property, and which is classified as a held for sale. And the property held by lessee as a ROU asset, then there is a separate standard for that, that is Ind AS 111. Then they will not adopt the cost model. When the company change the purpose or use of the investment property, if the company change the purpose or use of the investment property, suppose the company previously is an investment property, but after some time they want to change their investment property to PPE, or from PPE to investment property. Can the company will able to change? Yes, the company will able to change, subject to the condition if there is an evidence of the change. For evidence, if there is a supporting evidence, or the purpose for the and there is a supporting evidence that the company is changing its use, with the company will show the evidence that that they are changing the use, so they can change. What if the entity wants to wants the change of classification, like there may be a building which was earlier held as a PPE, but now the entity wants to reclassify it as an investment property under Ind AS. Building is there, company is using as an office building, but now they wants to reclassify it as an investment property. Then can the company do? Yes, company can reclassify it. The transfers are possible to and from investment property if they are done within the given frameworks. What are the frameworks? An entity shall transfer a property to and from investment property when and only when there is a change in use. They can change the purpose, then only they can. But only the intention is not sufficient to transfer the property from investment property to PP, or vice versa. Only intention of management is not sufficient. Change in use occur only when the property meets or cease to meet the definition of investment property. If the company is not anymore an investment property, company does not satisfy the definition of investment property, and there is a certain evidences of the change in use, then only the company will change transfer are possible from investment property to PP, or from PP to investment property. Means when they cease to meet the definition, and there is a supporting evidences for the change in use by the management. If there is some cash crunch by the management, and they want to lease out that property. There is office building and company having a cash crunch, and they want to lease out that property for renting purpose. Then there is a supporting evidences that the company wants to change the classification because of the cash crunch because the company is facing some cash crunches. For that purpose, the company wants to reclassify that asset from PPE to investment property. So there is some supporting evidences. Only intention of management is not sufficient for this purpose. In isolation, a change in management intention for use of the property does not provide evidences of the change in use. Only intention of the management does not provide evidences. There is some evidence, some reasons behind that for the transfer. Then only the transfers are possible. Examples of change in use. That is, there are some examples which are going to discuss. Serial 1, particular change to journal entries and remarks. Like commencement of owner occupation or development with a view to owner occupation for a transfer. Means company has previously used that property as an investment property. Now they want to commence that property as an owner occupation or development with a view to owner occupation. They commence that property, or they develop that property as you will use as owner occupied property. So they are changing from investment property to owner occupied property. So journal entry will be PP account debit to investment property. And there is no change in the carrying value when the transfer takes place. The carrying amount of the investment property at the date of transaction will be the opening value of the PPE, of the owner occupied property. Commencement of development with a view to sell and therefore transfer. If the investment property is there and that property is becomes an inventory, their purpose is to develop that property and with a view to sell that property, then that become the from investment property they becomes an inventory as per Ind AS 2. Then the journal entries will be inventory account debit to investment property, and there is no change in the carrying amount when the transfer takes place. The carrying amount of the investment property becomes the opening value of the inventory at the transaction date. End of owner occupation for means owner occupied property is no more existed, it becomes an investment property. So it's changed from owner occupied property to investment property. Then the journal entries will be investment property account debit to PPE, and the same, there is no change in the carrying amount when the transfer takes place. At the date of transaction, the carrying value will be same. Inception of an operating lease to another party for a transfer means if there is an inventory, that inventory is converted into an investment property, then investment property account debit to inventory, and the value will not be changed, it will be same. The carrying value will not change at the date of transaction. There is an example. Suppose X Limited has an investment property, that is building, which is carried out in the balance sheet as on 31st March 2022 at rupees 50 lakhs. During the year, the X Limited has stopped letting out the building and use it for office purpose. There is a change in use. Previously, they used for investment property, but after that, they use that asset as a PPE. On 31st March 2022, the management estimates the recoverable amount of the building at rupees 40 lakhs and its remaining useful life is 20 years and the residual value is nil. How should X Limited accounts for the above investment property as on 31st March 2022? There is you can understand that there is firstly there is it's an investment property, then it becomes a property, plant and equipment. There is a change in use of property from investment property to PPE. And there also an impairment loss. Impairment loss on the value of the property which becomes 40 lakhs and the carrying amount of that value will be 50 lakhs. The recoverable amount will be 40 lakhs and the carrying amount will be 50 lakhs. So what was the journal entry? The PP account debit, that is 40 lakhs, to investment property 40 lakhs. Impairment takes place. Impairment loss is there of 10 lakhs. Impairment loss account debit, that is 10 lakhs, to investment property 10 lakhs. Impairment loss is charged to P&L. And there is also a depreciation that is to be calculated, but I am not calculating this. This is for understanding purpose. Now, treatment in case of de-recognized of the investment property. If the company de-recognized the investment property, what was the treatment? An investment property should be de-recognized or eliminated from balance sheet in case of disposal. If the company wants to sell the asset, company sell the asset, that time they will de-recognize or eliminate that asset from the balance sheet, or if the company does not have any future economic benefit from that company does not expect any future economic benefit from that asset, then they permanently withdraw that asset from the balance sheet. Means when the investment property is permanently withdrawn from use and no future economic benefit are expected from its disposals, then the company will de-recognize that asset. This is to be explained by example. Suppose there is a building which is constructed by the company, and after construction the purpose of the management is to let out that building. but the government has banned that building for letting out purposes, and the future economic benefit is not flowing to the entity. So in that case, they will de-recognize that investment property. If and that in case of de-recognition, any profit or loss, any gain or loss arises, that gain and loss is to be will go to the P&L, profit and loss account. And if the company is entitled to receive any compensation from the government for any impairment or loss, then that compensation is to be recognized to P&L until and unless it will be received. When it is received, only in that only at that time they will recognize that compensation in the P&L. Now, what is the difference between Ind AS 40 and IAS 40? That is IFRS 40 and Ind AS 40. There is one major difference is that IAS 40 permits both the cost model and fair value model for measurements of the investment property after initial recognition. But Ind AS 40 does not permit. Ind AS 40 only permits cost model for measurements of investment. Disclosure. An entity should disclose its accounting policy for measurements of investment property. Means its accounting policy whether the company is using the cost model for investment property, because cost model is only allowed, and the extent to which the fair value of the investment property as measured for disclosure in the financial statement is based on the valuation by the independent valuer. Means they have to disclose the fair value of the investment property which is valued by the registered valuer, uh, and if they had not disclosed that valuation, they had not done the valuation, then the fact shall be disclosed why they had not done the valuation. And the amount recognized in the profit and loss account, that is the rent which is received by the company as a rental income. If any operating expenses are there, direct operating expenses arising from investment property that generates rental income during the period, and direct operating expenses arising from investment property that did not generate rental incomes during. Both the operating expenses is to be disclosed which generate rental income and which does not generate rental income. And the existence and amount of restriction on investment property. What kind of restriction on the investment properties are there is also required to be disclosed, and the existence of contractual obligation on purchase or on development of investment property. If there is any contractual obligation at the time of purchase or during development on investment property, that also required to be disclosed. General disclosures also required to be disclosed, like which method of depreciation is to be adapted by the company, whether WDV method or SLM method, or which method is adopted by the company, what was the useful life of the asset, gross carrying amount, accumulated depreciation, impairment loss if any, and net carrying amount. Reconciliation of the carrying amount of the investment property at the beginning and at the end of the reporting period is also required to be disclosed, and the fair value of investment property is required to be disclosed. For disclosure purpose, fair value is required to be disclosed, but for accounting purpose, fair value is not required. Only cost model is required. Thanking you for watching my video. If you like, please share and subscribe my channel.